Thank you so much for joining us. I know there are so many other very interesting panels going on at the same time, but this is going to be a very interesting one, but also a panel on a very, very important topic. I am Varun Rai. I'm an assistant professor in the LBJ School of Public Affairs and in the Cockle School of Engineering at UT Austin. My research focuses on innovation diffusion in the energy industry with a particular emphasis on the role of policy in that process. And this panel really is born out of one of my recent research projects on real and imagined barriers for investment in clean energy technologies. Over the course of that project, it was a tremendous opportunity for me to get to interview 25 of global experts in the clean tech community throughout. And of them, I'm especially proud to present to you 3 remarkable individuals who have, excuse me, and continue to shape various institutions of clean tech investment in the broadest sense possible, and you will get to hear some of that very soon. But before I introduce the panelists, let me take a couple of minutes to set the stage for the discussion. The unprecedented environmental and socioeconomic challenges posed by climate change necessitate innovations across the energy innovation system. Assistant Secretary David Danielson yesterday talked a bunch about that, how important that is. The scale of the necessary change and challenge is important to keep in mind. A global energy system that would help limit potentially catastrophic damages from global climate change will need to be very different from the energy system that we have today. Thus, in many ways, combating climate change is really an innovation challenge and one with a ticking clock. A central question in that challenge is how to fund the breadth and depth of necessary innovations. In the past, the clean tech the venture capital industry has been very central to funding risky innovations in a range of industries, especially semiconductors, information technology, and biotechnology. However, since surfacing as a serious component of the venture asset class, clean tech has been a roller coaster ride, to say the least, for venture capitalists. And so it will be very interesting to discuss what that role really is, but then also what some other emerging alternative mechanisms might be. When I started delving in this area a few years ago, I was very surprised by the lack of serious analytic research and analysis in this area, and so I decided to do a little bit of my own research here. And let me just very quickly highlight to you a few dimensions of what emerged as important dimensions in the research, and then hopefully we can have more discussion in the panel. It's common knowledge by now that clean energy technology investment is not favorite area currently for investors. But there's a lot of confusion around why that is, and a common sense is that, well, there are some very, it's capital restrictive, there is not enough capital. What we found that, that is necessarily not the case. In fact, it is the market technology and regulatory barriers that actually turn out to be more important than specifically the need for capital. We'll get into some of that and what that means. Relatedly, demonstrated returns and some more high-profile exits can lead to change in perception of the investors. And one of the things we learned is the perception of investors, while maybe negative now, it's also fluid, and that can quickly turn around and some important barriers are addressed. Third, there is need for signaling mechanism. This one is a very important issue, and it's essentially a mechanism to signal technological and operational competence at several points through the maturation of these technologies. And then finally, the emerging role of clean corporate venture capitals. That's a very important space, which is becoming increasingly active and should be interesting to watch. Let me, before I introduce my panelists here, let me give a shout out to Eric Funkhauser. Eric was my former student and currently a senior consultant with Research into Action. He was very critical to the success of this project, but then also in making this panel happen. Thank you very much, Eric. Now over to the panelists. We have, as I said, 3 really remarkable individuals with us. Nancy Fund, she's the founder and managing partner of DBL Investors, which is a leading player in the growing field of impact investing. Currently or in the past, Nancy sponsors or sits on the board of directors of several companies, including SolarCity, BrightSource, and prior to their public offerings, Tesla Motors and Pandora Media. We are very delighted, Nancy, you could join us.
Great to be here.
Jonathan Silver. Jonathan is one of the country's leading clean energy advisors and investors, and is currently the CEO of Green Bank Global. During the first Obama administration, Jonathan led the federal government's $50 billion clean energy investment in a range of different technologies. Among his many distinctions, Jonathan has served as a senior policy advisor to 4 US cabinet secretaries, including energy, commerce, interior, and treasury. I haven't seen many people with that distinction. Jonathan, thank you for being with us. And last but not least, Dr. Ashby Monk, who is the executive and research director of the Stanford Global Project Center. He's also a senior advisor to the chief investment officer of University of California. Recently, he was named as one of the most influential academics in the institutional investing world. His current research focuses on the design and governance of institutional investors with a particular focus on pension funds and sovereign wealth funds. Please join me in welcoming the panelists. So with that somewhat of a longer introduction, I would like to launch into the panel discussion, and we will do the discussion in rounds. We'll take a short question, have reactions from each of the panelists, and then maybe do some follow-on questions and move on to the next major topic. And just to begin and get some thoughts on the floor here, I would request each of the panelists to make some initial remarks, perhaps focusing on what has worked and what has not worked for clean tech and why. Nancy.
Okay. Small topic. Just a sentence or two. First of all, Varun, and thank you for inviting us, and it's great to be at the South by Southwest Eco. It's my first time here, and it's just a delight. So sure, it's, a roller coaster is one of the metaphors I use sometimes to describe the clean tech investing journey, ups and downs. But I do think that there is a pattern, and that we're moving from some of the very tumultuous early days to one where, while we could use more capital, the quality of the deals and of the management teams versus 10 years ago when we got started is completely different. And in our world, in venture capital, that's more than half the battle, is getting good teams that know how to build businesses. And there are a lot of pundits out there that say what's right and what's wrong. From my own view, one of the things that people always say is, oh, it's too capital intensive and you shouldn't invest in clean tech because of that. Well, if we had followed that, Tesla wouldn't exist. Sometimes you got to place the big bets. You got to get help from your friends, but you need. You can't build some of today's significant companies with, unless they're all software-based, without significant amounts of capital. Now, what I always say is I wouldn't want a portfolio full of Teslas. I don't think I'd have a nervous breakdown. But you can pepper a portfolio with a couple of those, and you're going to win some, you're going to lose some. So I believe that there is a role for capital intensity in moderation, and that you need to reach out to different kinds of funders to get those done, because there has been a lot of trouble in that first generation of clean tech investing. But I will say, having been a venture capitalist for most of my career, it isn't that different than the early days of the internet. I mean, when Netscape was a venture investment, everyone made a lot of money, but for every Netscape, there were a lot of failures back in that 2000 timeframe. So sometimes I think we're our own worst enemies, and that we shoot ourselves in the foot, that we're not as bad as everyone thinks we are, and there are a lot of happy LPs out there that have learned the investment paradigm, the way that we have. And so what we just need to do is have more people with track records that get more exits, and then I think some of the problems will start to solve themselves.
Thank you, Nancy. Jonathan?
Good morning. In the solar space, they call the roller coaster the solar coaster. I don't know what they call it in wind, but I would say that there are a couple of quick observations. The first is you have to distinguish between what kinds of investments are being made. Some kinds of investments in this space, like power generation, really are capital intensive. And one of the early mistakes that some investors made was to misunderstand the economics and the return profiles of power generation. So when you think about it, clean power looks just like fossil power in this regard, in the sense that it is capital intensive, it is illiquid, and to a certain extent it has bounded returns. And all three of those things, as a former VC, not a current VC, but a foreign VC, all three of those things are anathema to venture capitalists, particularly because they're anathema to their returns. On the other hand, this is not a monolithic sector. So power generation is over here, but energy efficiency and sustainability and other kinds of things are here and are much less capital intensive, and not surprisingly are an area in which capital has begun to flow. The second observation I'd make about the challenges, though, is that a lot of activity, a lot of businesses, in terms of the way they've been structured and their business models, seem to rely on and require behavioral change. And that's a really hard thing to do, and takes a really, really long time. I have 13-year-old twins, and they undoubtedly will do all those things. In fact, do them now sort of as a first nature. But for the rest of us, it's a learning process and a learned behavior, and that takes some time. The third thing I guess I'd offer is that a lot of what happened originally was generated in part by public policy, and the reference that Nancy's kind enough to make around to Tesla is that when this big federal government fund that I ran underwrote and financed the Tesla financing by providing a $550 million loan. So it leads to the observation that for large capital-intensive investments, particularly in cutting-edge technologies, public-private partnerships have been and probably remain important to the process. What I am pleased to see, however, is that the conversation that used to be we can't do this, and then was we do it for marketing purposes, and then was we can't do this unless there are government incentive programs in place, has really actually over the last year and a half, in my experience, really become a conversation about return on investment and IRR, et cetera. And what that means is we've crossed the chasm, no pun intended. We've crossed the chasm of how do you turn this into a conversation about business economics. And so I think that's in the context of the fact that this industry is one of the 2 or 3 largest global industries in the world and will continue to grow at above normal rates for the rest of our collective lifetimes in this room, seems to me a very attractive place to be. And it's one of the reasons why, although there isn't capital flowing into the space now, there's sort of a backup, a tsunami of capital that I can see waiting to figure out how to come into the space.
Thanks, Jonathan. Ashby?
And that's my cue, the tsunami of capital. It's just behind me here. It's a giant, weird brown wall. So I work with what I would describe as the base of our capitalist system. I don't think everybody appreciates, maybe most of you in the room appreciate, but the base of our capitalist system is made up of pension funds, sovereign funds, endowments, foundations, family offices, insurance companies. It's not the frontline hedge funds, venture capital funds. Those people get their capital from somebody else. They're managers, the latter. The former own the assets. The OECD would tell us there's 100 trillion, with a T, dollars sitting in long-term investment organizations, which they define as organizations with intergenerational time horizons or intergenerational liabilities. A pension fund with a 30-year liability is an intergenerational organization. I'm not really interested in convincing that 100 trillion to do impact investing. I'm interested in convincing that 100 trillion that some of the fundamentals of impact investing are just investing. Find me an investment on Earth that doesn't have an impact on somebody, whatever it is. Every investment is an impact investment. It's about speaking the language to this big community of institutional investors, the 100 trillion, and helping them understand that they are long-term, they have scale, and they have an ability to bear liquidity risk. We heard Nancy say it. We're not going to solve the climate crisis without putting some big bets into our portfolios. Right now, the community of institutional investors is putting their head in the sand. We have been taught growing up that markets are efficient, that actors are rational, all risks are priced. It's baloney. I mean, I'm sorry to say, it's baloney. We've gone 50 years since Markowitz created modern portfolio theory, and in that time, the average time horizon of an investment has shrunk from about 8 years to less than half a year. If what you want to do is build a game-changing company that takes a long time horizon to gestate. What are you going to do? Where are you going to turn? So I would flip your question, Varun, around and say, you know, what about clean tech works for the biggest pools of capital in the world, and what doesn't? Because if we can't get that 100 trillion moving, then I think we're in trouble. And so the work that I do is trying to make long-term investors aware that they can't ignore the climate crisis, that if you have a 10-year horizon or more, you just can't ignore it. This is a dislocation that's sitting there in your portfolio waiting to happen. And frankly, even if you are the most strident skeptic, it's a risk. And investors, which I would consider myself one, managing $100 billion with the University of California, working with the Australian Super Fund, another $80 billion. I wrote their business plan for their organization. Their direct investment organization, I should say. What we tell them is, this is a risk, and you manage risk. We're all risk managers in the investment business. We get paid for taking risk, and right now, the climate crisis is a risk that's not priced. And then we say, you shouldn't ignore it. If the rest of the market is ignoring it, and we both can look around and say, you know what, what's missing from this world in 15 years from now? It's probably a new energy paradigm. You, unlike 99% of the private sector that only holds assets for 6 months, you, Mr. Big Pension Fund, Sovereign Fund, have a capacity to deploy capital over 15 years and create little sleeves of portfolios that allow you to position a broader portfolio for that future eventuality. I can make an argument quite convincing that ignoring these trends are breaches of fiduciary obligation. I can start to make these arguments that this is what a prudent person would do. This is important. These are buzzwords in the pension fund world. But it's hard, okay? This is, nobody around the room, when I say public pension fund, thinks innovation, creativity, okay? Despite the fact that this is the very foundation of capitalism, creative destruction. The governance is wrong. We need to help long-term investors be long-term investors, and when Varun comes back to me, I'll give you a little insight into what that could be.
Great, thank you, Ash. Before we move on to round two, why don't I ask a little bit of follow-up questions just to get some more insight. Nancy, to begin with you, can you give us a stock of what the VCs are focusing on in this area? Where are they headed to with all the lessons and learnings that has happened in the past few years?
Well, I'd say that there is a continued interest in the large markets like solar and electric vehicles, storage. Obviously, we've been working on storage for a long time, toiling away in the lab, and now it's ready, becoming ready for prime time. So I think you're going to see a lot of very strong news from that over the next few years. Finance has played a huge role, and we've obviously been beneficiaries of that from investments in companies like Solar City, but a lot of people think that that's like the be-all and end-all, and it isn't. We just had a company sold that makes tracking systems, and we held it for less than 2 years and sold it to Flextronics, Nextracker, at a really nice multiple. And so good old-fashioned American innovation in hardware has been a place where people have made a lot of money. It's just not quite as heralded as the finance. I mean, so we need it all. So we're looking at more storage, microgrids, and not your county hospital microgrids of the 20th century, really modern, interactive, large-scale microgrids that enable adjustments in demand as well as adjustments in supply. We're looking at mapping and imaging technologies because those are getting cheaper and faster, and you'll be able to have information on your phone the way you listen to a song on your phone pretty soon, because those costs are coming way down, and so that will give a whole new battery of tools to folks fighting climate change. Circular economy, international, after years of NGOs and the government's funding efforts to get over a billion people in the world that don't have electricity to stop using kerosene and dirty cook stoves. Now that's an opportunity for venture and for the private sector to kind of scale the learnings that have happened over the past 10 years. So that's a very interesting area. So it's pretty diverse, and I would just say that when you are able to show people that you're investing in these kinds of things, it underscores what Ashby was saying, that, you know, if you don't invest in this, it's kind of like hanging on, you know, years ago to your Wang computer stocks when, you know, Apple was and the PC and everything was changing, and kind of, if you had done that as an investment officer, you might have gotten fired. You know, it's like you're supposed to make these innovation shifts, and we are in an innovation cycle now, and partly people don't recognize it because it's been your grandfather's electricity industry for 100 years, and so people are like, it's like Rumpelstiltskin, where you were kind of waking up and, oh, it's actually changing. And so we were successful in getting endowments into our most recent fund because we kind of said, you know, it isn't about the students knocking down your door, although, you know, that's obviously something that's annoying to you. It's about, you know, do your job. You know, this is an innovation cycle. Let go of the past and invest in the future. And that was successful for us.
Nancy, let me follow up on that. A common notion going around right now is, given the negative experiences in this space for VCs, there is much focus now on IT-oriented startup. But what you just said is in quite some contrast to that. You know, that's more of a positive story, looking at more diverse set of what innovations have to offer and where we need to head. So do you think this is, you know, I mean, you have been very successful, one of the few people who has really been there because of your vision and, you know, other things that have happened. But do you think that it's more symptomatic across the VC supply chain?
Well, I meant to include IT. It's just that IT is so embedded. I mean, Solar City, which you think of as a bunch of installers on rooftops, has so much software expertise. I mean, and the microgrid companies, you know, they're not sitting around kind of figuring out where to put the panels and where to put the batteries. They're writing software to make it all connected and interconnected to the grid. So also big data as it applies to agriculture, you know, that's an industry that needs disrupting. You know, we need to feed, you know, the people on this planet in a sustainable way, and we need to make sure farmers earn livelihoods that allow their children to stay on the farm. And big data can empower farming and make it more sustainable in a way that wasn't available even 4 or 5 years ago. So that's another investment theme that we have. And I think this, to answer your question, you know, we need it all. You know, and we believe in diversification. We're not 100% clean tech, and I think that's been a wise decision. But you know, we're not. So all those people that say it's all IT, that's not smart. I mean, you should, you know, IT plays a role. But look at where the money's been made, and as an example, last week it wasn't an IT play. So I would encourage people to let go of some of these, you know, theories that they've honed, and kind of look at the real world and see where companies are succeeding and where investments are returning, you know, big multiples to their investors.
Great, thank you, Jonathan. Follow up for you. Could you give us some insight into the mechanics of some of these large government funds? What were the major lessons? What you think worked best in that situation? But then also the dichotomy of using some of those funds, spreading them more widely, even upstream in the innovation system, right? You know, in the national labs or universities and so on. How did you navigate some of those dynamics?
Well, I spent a considerable amount of time pulling arrows out of my posterior, but so the government actually funds along a continuum from basic research through CRADAs and other kinds of participation at the national labs with independent researchers and entrepreneurs, through support grants and cash grants of various kinds for technologies that are somewhat more farther along the curve, up through and finally to deployment at scale, which is what my colleagues and I were working on with this $50 billion pool of capital. So the lessons learned vary by where you are and where you want to be in relationship to what the government, and when I say government, I'm talking federal, but actually this is equally true at the state, less so at local, where there just aren't the resources to do this. But the lessons learned are, to a certain extent, unique to the kind of capital you're looking for, but there are, I guess, some shared observations. One is that the federal government strives to be a good partner, but it is difficult, it is complicated for the folks who work there to do that. I'll give you just a simple example. When I first went to run the loan guarantee program at the Department of Energy, it seemed natural to me as a former VC and others to hire a small group of people to send them out to look for the best and most interesting technologies so that we could bring them in to fund them. Except it turns out you're not allowed to do that because in some sense, and I can understand the kernel of truth in this, that advantages one group of people and disadvantages another. And so, in fact, the only transactions we're able to do were with companies, organizations that had made an application into the program. And the single characteristic that all of the companies that received funding, the single characteristics, many of them were terrific, like the Teslas of the world, and we tried to do nothing but good deals. And I think we did. The portfolio now will produce about $5 billion of profit for the government. But the single characteristic they shared was that they'd all applied. That's it. And so, fortunately for me, there were hundreds and hundreds of applications, and we were able to cull from them the 35 or so that we thought were most attractive, and work with them and bring them to closure. But so I guess that would be the first observation. It is worth, in my opinion, looking for public-private partnerships when the amount of capital you need is significant, or the technology you're working on is literally bleeding edge. In the middle, maybe not so much. Having said that, in lessons learned, grants are far easier to come by than loans and other kinds of things for several reasons, none of which will make sense to you as entrepreneurs, perhaps, but are reasonable within the unusual context and surreal world of government. The first is that they're small, and so therefore they're not tracked the same way. And the second is that there's so many of them that they almost every congressional district has one. And therefore, right, there's support for programs, broad-based programs, because lots of people benefit. When you put $500 million behind a single company in a single location, you can understand some of the concerns, legitimate and otherwise, around that particular transaction. So I'd say that's a couple of lessons learned. There are plenty more, but it's worth it, but it's hard.
Mm-hmm. Thanks, Jonathan. Ashby, follow-up for you. Could you give us an example of one of these large funds actually doing these investments through some mechanism? And that will ground us a little bit more, because that's a space that is not normally thought of. Yeah, sure. Even though, as you laid out, that is the holy grail, it seems like.
Absolutely. Can I, just because I got to go last, so I get to react to some of their things.
Please do. Please do. And feel free to react to each other anytime.
$5 billion of profits. Incredible. Good for you. And that is even with the company that shall not be named.
Correct. That's correct.
So
and furthermore, it's $5 billion. Kidding aside, it's $5 billion of profit at the government's charged interest rate, which is 1.5% to 2%, okay, as opposed to just slightly below market. At market rates, it would be almost double that. And again, this has nothing to do with us and our little team. We worked hard. We tried to do good projects. It actually has to do with the fact. I'm sorry, I don't want to. He gets more time. It actually has to do with the fact that risk is mispriced in the government sense of the word too, right? Because project finance, which is fundamentally what we were doing, is a relatively low-risk investment strategy, right? Virtually every power generation project of any kind, including fossil projects, et cetera, have offtake agreements, and the offtake agreements are generally with AAA-rated utilities. So unless you do something materially wrong, or there's an act of God of some kind that causes something to really go awry, the project is going to work. The disappointment for the program and for the government process in this is that the company that shall not be named was the very first investment that was made. I might say as a sidebar before any of us got there, but
Not my fault.
not my fault. But here's the problem, was a manufacturing company. You can't use project financing techniques for a manufacturing company because you have no idea what the cash flows of that business will look like, which is how project finance folks get repaid.
But Tesla was not a project finance, and that worked, so.
Right, but, well, yes. Then you get into guarantees. That's a different issue. But anyway,
Great.
sorry.
So part of the reason I wanted to bring back the $5 billion profit was to have that conversation and get it out of the way. But also, I think what a lot of us are trying to do, whether you're an impact investor, whether you're a government, you're trying to catalyze capitalist activity in the right direction. None of us want to swim against capitalism, right? It's rushing river, it's doing, 50 miles an hour down a, whatever it is, category 5. It's going. You're not swimming back up capitalism without sincere, hard effort. Let's flow with it. Let's move in the right direction. And everybody in this part of the world seems to think that government really has no place in catalyzing, even though it does. If I look at some of the funds that I've worked with, Singapore's Temasek, this is a government investment fund which has for obligation to develop Singapore. You'd think to yourself, gosh, they must have just cratered as an investment organization. It's done better than Yale. It has 18% returns over 40 years. Malaysia's Khazanah, okay? You might say to yourself, what is this crazy organization going around and reforming state-owned enterprises and catalyzing local activity? Last 10 years, it's made 13%. So this is possible. It requires good governance and interesting and creative insight. The other thing I might say, just in reaction to something Nancy said, was I think we really need to be careful not to hang our hat on venture capital for these big guys. If we want to bring back the trillions of dollars into the space, venture capital doesn't make sense for these big guys. The allocations, the mandates, they're too small, they're too expensive. What we need to do is find the access points where they can write 50, 100 billion, million checks and help them fill the pipe of capital so that people like Nancy can then have the entrepreneurs looking out into the capitalist ecosystem and saying, gosh, if I build something that ticks these boxes, there's capital waiting. I'm going to dedicate my life to doing this for 9, 10 years. Right now, that capital's not sitting there. So everybody's saying to themselves, well, why am I going to go do that? I'm going to go do one of these capital light things that a VC is willing to back, and we can get an exit in 2 years at a nice multiple. But is that necessarily going to solve our big climate crisis? Now I'll answer your question, Varun. Ready for that?
Yeah.
So I worked with 3 large sovereign wealth funds, the Abu Dhabi Investment Authority, the Alberta Investment Management Corporation, and New Zealand Superfund. And I can talk about this now because one of them put it in their annual report. We had a thesis, which was the later stage equity in the first of a kind projects for energy innovation and resource innovation companies in Silicon Valley. These were assets that weren't getting big long-term capital. And coming out of the clean tech crater, we walked up the edge of that thing. It was still smoldering, and looked around and said, you know what, there's still a lot of great companies here. Yes, the VCs got a little crazy, invested way too much in things that were not fully baked, but 5 of these 100 companies are going to be the next great energy companies. And if we 3 sovereign funds, pension funds, and there was a couple other foundations that came along for the ride. If we all can find companies pooling our resources together as organizations across geographies, take the 15 people we have on staff in Abu Dhabi, in Auckland, in Alberta, that understands energy, reconceptualize what it means to deploy capital as a group, what we described as reintermediation, and go out and find the top companies and make pretty big commitments to them. One company received $500 million from those 3 investors in Silicon Valley. And over the course of 1 year, we probably looked at 140 companies, chose 7, and deployed $1.2 billion. Now, the names of the companies are all still locked away, but what I can say is all those companies are still going. Alberta Investment Management Corporation made some huge errors, which is in the public domain by the names of Kior and Clara. That's all out there. But when we pooled our resources as a community and brought new and interesting access points to these assets, as in we had 15 people across pension funds and geographies looking at companies trying to add value. The 7 we picked and the 1.2 billion we deployed are still going. And that 1.2 billion has appreciated. But it's a long haul, and those commitments are going to need to be followed through for a decade.
Yeah, Nancy, please.
Just on the role of venture capital, I completely agree that it's not the only asset class. Obviously, we need it all. But the thing that venture capital does that other asset classes don't do is capture the aspirational aspect of what this is all about. I mean, there are a few people in the world that want to grow up to be like the three of us, maybe a few, but there's gazillions that want to grow up to be Elon Musk or, Lyndon Rai. I mean, those kinds of companies are the ones that move generations and move them from the old to the new. And then they grow up and they can take, Solar Cities had at least $1 billion of capital amassed. So I think that venture capital plays that role of the popular culture as well as driving innovation, and I think that's super important.
Can you invest in an asset as a venture capitalist that takes 14 years, 15 years to gestate with the existing fee structures?
Yeah, we have a company, Revolution Foods, which is the darling of the impact investment world. It serves healthy lunches to low-income schools. And it's just growing, and now it's developing healthy lunchable products. The bane of every parent's existence is that lunchable that your kid wants going to school. So we make healthy ones. I think it's probably approaching its 10th year, and we're just doing another financing. Every financing has been up round. We got Steve Case in the last one, and we have a plan. And we are able to work with our LPs because they love the company and they've known it since it was an infant. But you have to, but I realize we're privileged because, we have investors that kind of get what we're doing. But that kind of education needs to be done at a much larger level so that you don't have your investors breathing down your neck, to exit after year 1 or 2. But sophisticated investors understand that sometimes there's a distribution as in anything else. I mean, there are companies that go public sooner than you think and others that get acquired later than you think. I mean, Tesla went public before Pandora in our portfolio, and they were kind of similar stories in terms of their gestation. And everyone else says, "Oh, it takes so long for clean tech to exit." Well, Tesla actually went ahead of one of our big wins in the digital music sphere. So I think there's a distribution, and to expect, you talk about Kior and some of the losses. You know what? If we're not losing some deals, we're not taking enough risk. And so don't expect us to have 100% track record. That's nonsense. And I'm, for example, BrightSource. I'm not going to make the kind of money I wanted to make on BrightSource, but I'm proud of that in terms of the role it's played in developing our understanding of large-scale solar, and it's now has a big opportunity abroad. So, I'm going to push back. I don't have to win every single investment. That's not the way to look at what we do. You have to develop a portfolio, and on the total of the portfolio, you end up making money for your investors.
So, real quick, Varun, I was talking about a pension fund writing a $200 million check at a very late stage, which included project finance. I think there's a different risk-return calculus that's taking place than what you're doing when you see a management team and an idea. I expect you to lose 80% of your bets, frankly. Maybe you're better than that. But when honestly, the best VCs actually, the research shows they lose more. In fact, the ones who swing for the stars will even lose more than that. But my point here is simply to say, what we need is to line up the big trillions. And the big trillions, when you see a 200 million goose egg on a project finance deal, that hurts. And that hurts the entire community.
The federal, at least speaking for the federal government is sort of in between these two conversations, right? Because the federal government has hundreds of millions and billions of dollars to deploy. The problem is the federal government is highly adverse to risk and really doesn't do well operating with shades of gray because when you think about it, the money being used is taxpayer money. And so there's a different level of responsibility is the wrong word, but caution, professional caution that needs to be undertaken. And it's one of the reasons why innovation at scale in partnership with the federal government is challenging, because somehow you've got to figure out how to finance innovation with almost no risk of losing the capital.
Before we move on to the next topic, and we do want to leave a few minutes for some Q&A, let me pose this to maybe Ashby, and then also related to Nancy and Jonathan's recent comments. It seems like Ashby, this really giant pool of money, can shift the earth here and really make a huge difference. What about the timing? In my opening comments, I said we have to deal with this in the next few decades, right? 40, 50 years, in terms of not just the innovations but actual deployment. How quickly do you think some of these giant funds, which have their own way and history and path dependence of how they think and how they operate and how they fund things, how quickly can they move to really take over in some sense?
So, it keeps me up at night. I have a 3- and a 5-year-old. I know what we're facing. I would say we need more people following the flow of capital all the way down to the base. Who here can tell me they truly understand and appreciate the way Middle Eastern sovereign funds make decisions as opposed to Asian sovereign funds, as opposed to a county pension plan like Sonoma, Contra Costa? If you can't answer that, then we don't really know how that long-term capital is being deployed. Yes, we've got brilliant intermediaries to my left that know what's happening at the level of the companies. But this is a chain of intermediaries that takes the big pools of savings and seeks to put it into the big projects that are meaningful, that have existential value to us as a race. If we don't understand what's going on in these big, boring asset owners, then we're in trouble. Can we make them move fast? Yeah, we gotta, it took a guy, me, working for free for a year, and we deployed $1.2 billion into 7 companies. It took another year to get another $1.2 billion of commitments, and we're creating a new, what we're calling, it's a terrible name, but it's called the Aligned Intermediary.
That is a
working title. So I wanted to call it an...
I think you're changing the name, aren't you?
Yeah, we're changing the name, thank God. But I've signed on to be chairman of this thing, and that's mostly just because I know all the big asset owners, and so they're like, oh, Ashby's doing this, okay, we'll do it, fine. Keeps beating us over the head. It was really an impact investment bank. That was what I wanted to call it. And everybody's like, oh, I hate that word impact. Trust me, the big pension funds of the world, they're like, we can't do impact. We have a fiduciary obligation. That's BS. You can't make money. And then the foundations that we were going to fund this thing were like, I don't want to work with an investment bank. And so it was like, Jesus, it's pissing everybody off in the perfect way. But so that's what we're doing. The foundations have put up money to launch this new entity. It's going to be a not-for-profit. We're going to bring in some brilliant people. We're going to curate deals for long-term investors that know exactly what they want. And there's about 12 of them out there. The Wellcome Trust, the New Zealand Super Fund, APG, PGGM. I can rattle them off because you know why? There aren't many. We're going to bring them deals. They're going to be deals that meet their due diligence standards, risk-return requirements. They're going to do those deals. Those deals will be good deals. They're going to meet their own standards. That's the key. And then the CalPERS and CalSTRs of the world will start saying, this isn't so scary anymore. That crater seems to have been filled in by something else. Maybe we can start moving back into this space. And that's when maybe, we convince Nancy to set up a clean tech fund and do $1 billion something.
I think everything Ashby said is right, and certainly at the base of the pyramid that he's describing. I actually think this is happening, not going to happen, but happening much faster than people think. I think that the notion that we are unable to get out ahead of the curve is actually outdated now. And I say that for 3 reasons. The rate of decline of coal in this country and around the world is happening much faster than I think people understand. And in my opinion, if you project out, not look at EIA data, but project out against trend lines by companies, we'll be out of coal in 15 years. We'll be out of coal. The second thing that happens is at some point, some analyst on the street is finally going to write a report that says, all the fossil companies' underground assets are not actually assets, they're liabilities. They're never coming out of the ground, and therefore you actually have to pay to maintain those, and that costs money. And as a result, the market caps of those companies are going to dramatically shift, and capital flows are going to move very quickly elsewhere. And I'll leave you with it last anecdotally as a thought exercise about the speed of implementation, for example, of electric vehicles. What is the resale value of a car with an internal combustion engine when the purchase price without incentive of that car and an electric vehicle are essentially the same? And the answer is, leaving aside muscle cars, vintage cars, people who want special kinds of things, zero. Right? And the reason for that is, of course, that there are a third fewer parts, less maintenance, no gas, et cetera, et cetera. So for you to believe that electric vehicles will always be a niche, you must believe that they will never be at purchase price parity. And Nancy can tell you better than I, but I'm here to tell you that'll happen next year. No, I'm wrong. The year after that. No, I'm wrong. 5 years from now. Here's what it isn't. It's not never, right? And so you have to look at this as a movie, not as a photograph, not as a snapshot. We're making tremendous progress here, and I suspect we are on track to solve these problems.
Nancy?
I just want to tell a quick story based on what Ashby said. When we got started, we were part of JP Morgan. I had worked at a company called Hamilton Quist, and then we were acquired. So we were part of this huge international bank. But our first fund, which was a tiny regional fund of 75 million, which was brutal, to raise in the early 2000 period. I mean, it took us forever, and we had to claw our way. And one of our first investor was the Ford Foundation, and they did it as a PRI, which is program-related investment, which means they could kind of take it out of their grant dollars as long as they didn't make too much money. It's kind of an IRS categorization. So it was weird, but Ford really helped get us on the map because it's got a great brand, and they helped us develop our metrics on job creation and all this great stuff. And then we pulled together the other investors, which were that got us MacArthur and Annie Casey, and then we got some banks from their CRA groups, and that was our first fund. But the day we closed, and literally this had been brutal, people had worked for free for 18 months. This seems to be a theme on this field. So we're closing, we're like, okay, cobbling it together, we're like, let's get this done. And we get this irate call from the president of the Ford Foundation. And she was just going ballistic because, she had to sign off. And she's like, what the heck are we giving JP Morgan money for?
Right.
Even though we had all these community groups we were working with, and we had worked all of this out, so that's, that just shows you how in the DNA of folks that have, their little boxes, and it's hard to shift those around.
Can I bring up the analyst report? Because I think that is important. The analyst report that says, this is a liability. So I live at Stanford as an academic, and then I drive across the bay and work at the UC they let me do that, as an advisor. Although I will tell a quick anecdote. When we went to Berkeley Labs, we had all these foreigners, and the Stanford professor was the only one that got pulled into secondary screening for security. Who the heck is this guy?
They understand the meaning of aligned intermediary.
Yeah, dude. So, at the UC, we've had students beating down our door and sitting in our office and, really getting after us to simply divest. And Stanford, had gone down the path of doing a quasi-cold divestment. I don't want to talk about that because I don't want to screw up my tenure case. At the UC, we decided to take a year and understand what it meant to price long-term risks and begin to make that case for ourselves, not for the whole portfolio, but to start saying, well, what makes sense as an organization that's been managing money for 80 years and expects to be managing money 80 years from now? Think about in terms of risk and reward. Are we getting compensated for taking all these risks? We built an investment decision-making process over a year, and with no fanfare, we sold, we did not divest, we sold all of our coal assets and all of our oil sands assets about 6 months ago. And that was an investment decision based on finance. The reaction that we've had from CIOs around the world is profound, because they are saying to us, wow, you finally made a case for doing what our students are, hospital professionals, our firemen, our police officers, our teachers have been begging us to do. But you did it with the Analyst Report instead of with the ethical, do-gooding behavior. And I think that is why I couldn't agree more that we need that Analyst Report so that more organizations have a leg to stand on.
We have about 6 minutes or so. We'll take a couple questions very quickly down the table. This was going to be round 2 of discussions. We never got there. If there was one major institutional or policy change that you could have, what would that be?
Well, I think Elon Musk gave a speech on Friday where he kind of pointed out that the market doesn't actually work in this field if you don't put a price on the costs of carbon. And so I think that whether it's cap and trade or price on carbon, you do need to have the scorecard be accurate, and you need to have a level playing field. And I've been writing for years about the lack of a level playing field, and so if you're going to continue to subsidize the fossil industry to the tune of billions of dollars in the tax code, you need to do something to support the emerging and cleaner energy sources. And maybe the way you do that is to get rid of all incentives, but only if it's done across the board. So I would just say that it's really a myth that the new entrants are under that have an abundance of incentives compared to the incumbents. So we need to fix that.
I think Nancy's exactly right. That's a huge one, and a corollary to that would be the way the government manages its social cost of carbon. But to pick something different so that there's more to discuss, I'll say the single greatest thing that could happen would be for the major rating agencies to get comfortable with scoring and reviewing clean energy projects and other kinds of financial instrument securitization products and the like, because those ratings drive the ability of mutual fund managers and others to make investment decisions.
I would take the compensation, the salary number of every public pension fund employee in the United States of America. I would put a times sign afterward, and then I would put a 5 after the time sign. And what that would mean is the boards of all these organizations would have realized they are the base of our capitalist system. This is capitalism. It's not a department in a university. It's not an agency wing. This is an entity that is going toe-to-toe with the smartest private equity managers on earth on a daily basis. And you need to fight fire with fire. So fine, those individuals in those seats would get a 5x bonus. We'd smooth it out over 5 or 6 years so that they're aligned over the long run. But over time, the people in those chairs would change. And I think if we really want to fix the problems that I think we all want to fix, this base of the capitalist system needs to understand a lot more than it is understanding today.
They should at least get paid as much as the football coach.
Well, and that's $6 million.
Yeah.
So that, okay, so but for that, we need a 20x.
This
Multiply
is the
by
University
20.
of Texas. They could be expensive.
Yeah. But we do have time for maybe a couple of questions. Let's see. Varun.
Hi, I'm Varun Rai from the Council on Foreign Relations. From the perspective of an entrepreneur who wants to start a basic science or new materials company, I see 2 big areas of confusion. One, where do you raise money from? From Nancy, from the government, from grants, from big loans, from Ashby and Auckland? And 2, what kind of company do you want to build? Do you want to build out just a technology that gets acquired? Do you want to build a company that sells products to consumers? I'd love your advice and takeaways on what lessons you learned from basic materials, basic science companies.
Well, we kind of approach it a little bit differently. I mean, the basic materials, the basic science is a means to an end. And what problem are you trying to solve? And is it big enough to matter? And so that gets you into, sure, I mean, a lot of the flow batteries are dependent on chemistries that haven't worked before and working very sophisticated procedures to get productive, cost-effective batteries and such. So we, just because it's a new material doesn't mean it's necessarily going to be commercial. So we'd want you to have more of a sense of why you're doing what you're doing and where it's going to be useful, and then make a case for that's actually going to move the needle. And then there are all the traditional questions of how long it's going to take you to get there, and will you have the right management team to pull it off?
Ultra high net worth individual / family office is what, if you're asking me today who you should go talk to, that.
And I think that the answer is you may or may not have a company, but you may have a really world-shattering technology, and therefore, not unlike what Wayne Gretzky said about skating to the puck will be, you should figure out where large corporations are looking for materials advantages and develop the product to suit their immediate commercial needs.
I would just warn, I don't know if this is you or a hypothetical, there is a lot of work going on this field, so all of our children are special, but you have to differentiate yourself because there's a lot of competition on that field.
Great. Very good question here. If you have a question, please just come up here, or just hold on for a second. Last question. Okay. I have a very hard.
Thanks for a great panel. So I have a question. So Nancy and Jonathan, you've both commented that the skepticism that limited partners have towards investing in funds that are focusing on clean tech is very fluid. So right now they're very hesitant to move into that space because they've seen these flubs. But if you start having winds roll in, their minds can change back to being completely bullish on clean tech just as quickly as they moved away from it. Then at the same time, there are others who argue we're basically seeing a bottleneck where we had a lot of losers up front after we started moving into this asset class since 2006, 2007, 2008. So now we're coming to the point where a lot of the good ones are going to start coming out. So my question is, if there is a series of wins that start coming in and we start seeing that attitude and that perception change, is there going to be entrepreneurs like Nancy and folks that you work with, Jonathan, that can step up and say, now give me a fund? You're on our side now, but all the folks that did a terrible job and lost their shirts, they're not going to get a fund. You'll get a fund. 2 or 3 others will get a fund. Are there 2, 3 dozen other folks that can come in and raise a fund when the mood turns back and can actually do well and we don't run into a catastrophe where we have a bunch of inexperienced people who've only worked in software trying to make these deals work?
Well, it's a good question. I mean, certainly our trajectory, that fund I mentioned with the Ford Foundation, that was $75 million. Our second fund was $150. We just raised a $400 million fund. So we clearly have enthusiastic LPs that get this. The problem is we need more people, as you say. And we have we've been doing this for a long time, for 12 years. So we have a track record, which makes it, it's never easy, but it makes it more straightforward to put a fund together. And so we would like to have more of those, have the farm teams out there developing those smaller funds and growing as we did. And it is beginning to happen. And even though impact is not popular with some folks, it's popular enough that there are a lot of firms, especially where we are in the Bay Area, that are developing an impact side, and they are more amenable to including sustainability. They don't just do that, but so we're finding ourselves partnering with some of these, more digital backgrounds, more traditional Silicon Valley types, but that have decided they want to do something different, and so they have a lot of great skills, and so we're knitting together some new syndicates, which we hope will be productive.
We're over time, Jonathan, so very brief response.
Oh, sure.
And then
I think there's a symbiotic relationship between general partners and limited partners, and all the general partners and funds who were doing this work who got crushed ran around saying, we don't do this anymore, please help us raise another fund and we won't ever do this again. And they either did or didn't. But at some point, as the work Ashby and others are doing begin to affect the decision-making process by the limited partners. As soon as a large limited says we want exposure to this asset class, every single VC that has any connection to this space will go, we do that. So I do think that you will see, it may not be the same individuals depending on what happened with their track record, but there will always be a place, a role for, and an increasingly large amount of capital available for this space through venture, for the very simple reason that it's one of the largest industries in the world and it's growing faster than any other industry other than healthcare on the globe.
I would just say that I'm a fan of Judo Moves, which is to say, let's not fight that behavior that is to herd. Let's use it in our favor as like a society, as a planet. And I think if we can show some wins to the big guys, which is why I'm doing this crazy not-for-profit aligned intermediary thing, we'll show some wins, and all the pension funds that herd will herd, and they'll follow. And that, I hope, when we bring them back to the table, we will have, I didn't even tell you about the other half of my research, which is about structuring aligned intermediaries. That's where the title came from for the darn thing. It's now tarnished forever, but yeah. You know, evergreen funds, operating on a budget. Like, how do you run a private equity fund that needs to operate in energy? That's the other strand of our research. So by the time we have a market that everybody's saying, huh, this looks really interesting, hopefully there's 20 better structured venture funds than we saw the last time around. And they're happening. I mean, you know, Generate, M&L Partners, like you name it. There's a lot of interesting vehicles out there that didn't exist 5 years ago.
Well, thank you so much for joining us and for enriching us with your experience. Thank you.